You are not a stock trader. Let that sink in. You might think you are. You might have an app on your phone with a list of tickers that flash green and red. You might feel a jolt of adrenaline when one of them moves sharply, or a pit in your stomach when it falls. But you are not a stock trader. You are a speculator. You are a gambler playing a game rigged against you. A game of flickering lights and fleeting emotions. A game designed by Wall Street to separate you from your money through a slow, steady bleed of commissions, bad timing, and anxiety. The very act of calling yourself a trader, of looking at those symbols on the screen, is the foundational error from which all other financial mistakes are born. Today, we are going to perform a kind of surgery on your financial brain. We are going to excise the part that sees ticker symbols and replace it with something far more powerful, something that forms the absolute bedrock of the greatest fortune ever built through the public markets. We are going to install the single solitary idea that separates Warren Buffett from every other person who has ever tried to make money in the stock market. The idea is simple, but its implications are profound. You are not buying a stock. You are buying a fractional ownership of a living, breathing business. This is not semantics. This is not a clever turn of phrase. It is a complete and total paradigm shift. It is the difference between renting a hotel room for a night and building the foundation of a skyscraper. The renter cares if the noise next door is loud tonight. The builder cares about the quality of the steel, the integrity of the concrete, and the economic prospects of the city 100 years from now. This shift in perspective, from stock renter to business owner, is the one true path to successful investing and lasting wealth creation. It is the antidote to fear and greed. It is the source of patience and discipline. It forces you to stop asking the wrong questions, like what is the stock going to do tomorrow, and start asking the right questions, like how much cash will this business generate over the next decade? Today, we deconstruct this master principle. We will break down what it truly means to adopt the business owner mindset, to see past the noise of the market and focus on the economic reality of the companies you own. We will journey through the 5 fundamental shifts in perspective, in analysis, in operations, in emotion, and in strategy that this one idea unlocks. This is not another video about stock tips. This is a lesson in a powerful investment philosophy, a new way of thinking that will fundamentally change your relationship with your money and your future. This is your first step toward graduating from a market speculator to a true intelligent investor. Our journey begins with the most critical transformation of all, the perspective shift from speculator to owner. To understand its power, we have to travel back in time, to see the master himself make the very mistake he would spend the rest of his life teaching others to avoid. It was 1942. A young Warren Buffett, just 11 years old, had been saving his money from his paper route, diligently putting away every penny. He had saved $120, a small fortune for a boy his age. He wasn't just a saver, he was an obsessive student of the market, charting stocks by hand, devouring every financial book he could find in the Omaha Public Library. He was ready to make his first investment. He convinced his sister Doris to go in with him, and together they bought 6 shares of a company called Cities Service Preferred for $38.25 per share. Now, why did he buy it? Did he perform a deep fundamental analysis of the oil and gas industry? Did he scrutinize the company's balance sheet and management team? No. He bought it for the same reason millions of people buy stocks every day. He thought the price would go up. It was a trade, a speculation on a flickering number. And almost immediately the market taught him a brutal lesson. The stock began to fall. It dropped to $35, then $30. It eventually bottomed out at $27 a share. A young Warren, watching his and his sister's hard-earned savings evaporate, felt a twisting knot of fear and regret in his stomach. He was checking the price constantly, feeling the sting of every downward tick. This wasn't ownership. This was a constant, nerve-wracking referendum on his intelligence. He felt the immense pressure of having risked his sister's money. Finally, the stock staged a small rally. It crept back up to $40 per share. Warren, desperate to escape the psychological pain and lock in a tiny profit, sold all 6 shares. He made a grand total of $5 after commissions. It was a moment of pure relief. The anxiety was gone. But then, something happened that would be seared into his memory forever. City Service Preferred didn't stop at $40. It began to climb, and climb, and climb. It eventually soared to over $200 per share. The $5 profit he had been so relieved to take would have turned into a gain of nearly $1,000, 8 times his initial investment. The lesson was not about the money he lost. The lesson was about the mindset that caused the loss. He had been focused on the price, not the business. He had reacted to the random, meaningless fluctuations of the market. His decision to sell was driven by emotion, the relief from the pain of a paper loss, not by any change in the underlying value of the city service company. He realized that as long as he viewed himself as a renter of a stock, a temporary holder of a ticker symbol, he would forever be a slave to its price movements and his own emotional whims. He had learned through the sharp pain of a lost opportunity that the only way to win was to change the game entirely. He had to stop being a stock trader and start becoming a business owner. This single, painful experience became the foundational anecdote for his entire career in value investing, a powerful reminder that the daily verdict of the stock market is often a liar, and the truth can only be found in the long-term performance of the underlying business itself. This personal failure was the seed from which his legendary portfolio management strategy would grow, a strategy rooted not in predicting stock prices but in understanding and owning great companies. What young Warren Buffett experienced with City Service wasn't just a case of bad luck or youthful impatience. It was a collision with 2 of the most powerful and destructive forces in investor psychology: myopic loss aversion and the endowment effect. Understanding these principles on a cerebral level is the key to appreciating why the business owner mindset is not just a quaint aphorism, but a powerful psychological shield. Myopic loss aversion is a concept pioneered by behavioral economists Richard Thaler and Shlomo Benartzi. It combines 2 separate ideas. The first is loss aversion, the well-documented fact that for human beings the psychological pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. We are wired to avoid losses at all costs. The second part is myopia, which means short-sightedness. When you combine them, you get a toxic brew for investors. Myopic loss aversion describes the tendency of investors to feel the pain of losses more acutely when they check their portfolios frequently. The speculator who watches the ticker every day is subjecting themselves to a constant barrage of tiny, painful paper losses. Each time the stock drops from $38 to $37, they feel a pang of regret. The market is a volatile place. Even the best stocks go down on about half of all trading days. By checking constantly, the speculator is guaranteeing themselves a steady diet of psychological pain, which makes them far more likely to make a rash, emotional decision, like selling at the bottom, just to make the pain stop. This is precisely what happened to Buffett. The daily drop in City Service was a source of constant anxiety. Selling at $40 wasn't a financial calculation. It was an emotional anesthetic. Now compare this to the business owner. A person who owns a local restaurant doesn't get a price quote on their business every second. They don't have a screen flashing the value of their pizzeria in real time. If they did, they would go insane. Instead, they focus on the fundamentals. Are customer numbers up? Are food costs under control? Is the new marketing campaign working? They think in quarters and years, not minutes and seconds. By adopting this mindset, the long-term investor automatically cures the myopia. They check their portfolio infrequently, which means they experience the gut-wrenching pain of loss aversion far less often. They are looking at the long-term upward slope of the business's value, not the jagged random walk of its daily stock price. The second principle at play is the endowment effect. This is our tendency to value something more highly, simply because we own it. If you own a coffee mug, you'll typically demand a higher price to sell it than what you would have been willing to pay to acquire it in the first place. This is where the business owner mindset creates a powerful positive bias. When you view a stock as just a ticker, a temporary rental. The endowment effect is weak. It's easy to sell it. But when you have done the deep work, the fundamental analysis, and you truly believe you own a piece of a wonderful business like Coca-Cola or Apple, the endowment effect becomes a powerful anchor of patience. You are not just an owner of a stock. You are an owner of a brand, a network, a piece of a global enterprise. This sense of ownership makes you far less likely to be shaken out of your position by a scary headline or a 10% market correction. You value your business more than the market does on any given day, which is the very essence of being a contrarian, long-term investor. By shifting his perspective, Buffett was subconsciously building a psychological fortress. He was learning to use the endowment effect to his advantage, anchoring himself to the business, while simultaneously neutralizing myopic loss aversion by extending his time horizon, making him a more successful investor through superior emotional control. This is a critical component of financial education that is often overlooked. Superior wealth creation is often less about financial genius and more about mastering these predictable flaws in our own human wiring. Translating this powerful psychological insight into a practical, repeatable process is where the real work of wealth creation begins. Warren Buffett didn't just have a philosophical shift, he developed a set of applied mental models, a blueprint that anyone can follow to move from the chaotic mindset of a speculator to the disciplined mindset of a business owner. The most potent of these is what we can call the 10-year test. It's a simple, yet profoundly effective filter to apply before you ever risk a single dollar of your capital. The blueprint works like this. Before you click the buy button on any stock, you must stop and ask yourself one critical question. If the stock market were to close tomorrow and not reopen for 10 years, would I be comfortable, even happy, to own this business for that entire period, completely unable to sell it? This question acts as a powerful clarifying agent. It instantly vaporizes all the short-term noise and forces you to confront the only thing that truly matters, the long-term quality and earning power of the underlying enterprise. A speculator could never answer yes to this question. Their entire strategy is based on the ability to sell, to get out of a position based on a price change. Their confidence is in the market's liquidity, not the business's durability. But for a potential business owner, this question unlocks a cascade of more intelligent, more fundamental inquiries. First, it forces you to assess the company's competitive advantage, or what Buffett, borrowing a term from his partner Charlie Munger, calls its moat. A business that can survive and thrive for 10 years without you being able to check on its stock price must have a powerful, durable moat. Does it have a strong brand, like Coca-Cola, that allows it to charge a premium? Does it have a network effect, like American Express, where each new user makes the service more valuable for all other users? Does it have a low-cost advantage, like Geico, that allows it to consistently underprice competitors? Without a durable moat, a business is vulnerable to the relentless forces of competition, and you couldn't possibly be comfortable holding it for a decade blind. Second, the 10-year test forces you to scrutinize the quality of management. If you're going to be locked into a business for a decade, you are effectively hiring the CEO and their team to be your partners and stewards of your capital. You would want to know, are they honest? Do they have a track record of intelligent capital allocation? Do they think like owners themselves? Or are they just hired hands looking to maximize their own salaries? This forces you to read their shareholder letters, listen to their conference calls, and evaluate their past decisions, not just look at the stock chart. Third, it demands a focus on the company's financial strength and earning power. Can this business survive a recession? Does it have a strong balance sheet with manageable debt? Does it generate consistent and growing free cash flow? You're not asking if the stock will beat earnings next quarter. You're asking if the business itself is a robust, cash-generating machine that will be significantly more valuable in a decade than it is today. Applying this blueprint is a rigorous exercise in fundamental analysis. It requires work. It requires you to read annual reports, understand business models, and think critically about the future. But this is precisely the point. It transforms investing from a passive, casino-like activity into an active, intellectual pursuit. By forcing yourself through the 10-year test, you are no longer gambling on price wiggles. You are making a deliberate, long-term capital allocation decision, just like a true business owner would. This mental model is the ultimate filter, ensuring that only the highest quality, most understandable, and most durable businesses ever make it into your portfolio, setting the stage for long-term successful investing. To truly grasp the genius of the business owner mindset, it's essential to shine a bright light on its opposite, the path walked by the overwhelming majority of market participants. This is the path of the 99%, the path of the speculator, the day trader, the momentum chaser. It is a world governed by noise, emotion, and a desperate search for shortcuts. The person on this path does not see themselves as buying a piece of a business. They see themselves as buying a lottery ticket with better odds. Their world is not the world of annual reports and cash flow statements. It is the world of candlestick charts, moving averages, and the endless shrieking chorus of financial television. Let's deconstruct the disastrous consequences of this approach. The antithesis of the 10-year test is the what's hot now strategy. This investor is a moth drawn to the brightest, hottest flame in the market. Their research consists of seeing what stocks are being talked about on social media, what tickers are rocketing upward on heavy volume, or what story a charismatic pundit is spinning. They suffer from a terminal case of FOMO, fear of missing out. They see a stock like GameStop or AMC soaring, and they don't ask, what is the intrinsic value of this business? They ask, can I get in and out before the music stops? The catastrophic dot-com bubble of the late 1990s serves as the ultimate historical example. Millions of ordinary people, caught up in the mania, poured their life savings into companies that were little more than a good idea and a fancy website. They bought companies like Pets.com, not because they had analyzed its logistics, its customer acquisition costs, or its path to profitability, but because the narrative of the new economy was intoxicating. They weren't buying a business, they were buying a story. They ignored the fact that Pets.com was spending millions on Super Bowl ads while losing money on every bag of dog food it sold. They were renters of a stock, and when the narrative collapsed, when the market realized these companies were hemorrhaging cash with no hope of ever turning a profit, the stock prices went to zero. The speculators were wiped out, not because they were unintelligent, but because they were playing the wrong game. They focused on the stock's price and story, while completely ignoring the collapsing fundamentals of the business. The path of the 99% is also paved with a dangerous obsession with complexity. The speculator believes there is a secret formula, a hidden technical indicator, or a complex option strategy that will unlock guaranteed profits. They spend their time trying to predict the unpredictable, the short-term mood of the market, rather than focusing on the understandable, the long-term economics of a good business. This leads them to become action junkies, constantly buying and selling, believing that activity equals progress. They mistake the frantic energy of day trading for the productive work of investing. Each transaction racks up commissions and taxes, creating a constant headwind against their returns. They are paying a premium for the illusion of control, while the patient business owner sits quietly, letting their companies do the hard work of generating profits and compounding their capital. This antithetical approach is fundamentally rooted in an external locus of control. The speculator is at the mercy of the market's whims. Their emotional state rises and falls with the S&P 500. Their success depends on correctly guessing what other people will do. The business owner, by contrast, has an internal locus of control. Their success depends on their own research, their own analysis, and their own patience. They have outsourced their success to the operational excellence of the businesses they own, not the fickle psychology of the crowd. The path of the 99% is a path of anxiety, high costs, and, for the vast majority, inevitable failure. It is a siren song of easy money that leads directly to the rocks of financial ruin. The shift from speculator to business owner is not just a philosophical or psychological change, it has a direct, quantifiable, and massive impact on your financial statements. It is the difference between a portfolio that steadily, almost inevitably, grows into a fortune, and one that sputters and stalls, eaten away by hidden costs and self-inflicted wounds. The most immediate and powerful financial connection is the drastic reduction in portfolio turnover and its two destructive children, taxes and transaction costs. The speculator, the action junkie, is constantly buying and selling. Each sale of a stock held for less than a year triggers a short-term capital gains tax, which is taxed at your ordinary income tax rate, the highest rate possible. The patient business owner, who holds their shares for many years, if not decades, defers those taxes far into the future. When they finally do sell, they pay the much lower long-term capital gains tax rate. This isn't a small difference, it's a colossal advantage. Think of it like this. The government is your silent partner in your investment gains. By trading frequently, you are inviting that partner to take their biggest possible cut every single year. By holding for the long term, you are telling that partner to wait, to let your capital grow and compound unmolested for as long as possible. Warren Buffett has held some stocks, like Coca-Cola and American Express, for decades. His fortune has been built on an ever-growing mountain of deferred tax liabilities, allowing hundreds of billions of dollars that would have been paid to the IRS to continue working and compounding for him. Every time a speculator sells a winning stock to lock in a gain, they are voluntarily sending a huge chunk of their compounding machine to the government, permanently reducing the capital they have working for them. Beyond taxes, there are transaction costs. While commissions are lower than they've ever been, the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for, is a persistent and insidious tax on activity. For the long-term owner who makes one transaction every few years, this is negligible. For the day trader who makes dozens of transactions a day, it is a constant, grinding friction that saps returns. It's like trying to fill a bucket with a hole in it. The more you move, the more you lose. But the most profound financial connection is how the business owner mindset allows the magic of compounding to work at its full potential. A stock is not just a claim on a company's assets, it is a claim on its future earnings. A great business like Microsoft or Apple doesn't pay out all of its profits to shareholders as dividends. It retains a large portion of those earnings and reinvests them back into the business, into research and development, new data centers, or strategic acquisitions. If the company can earn a high rate of return on that reinvested capital, say 20%, then every dollar they retain for you is automatically being compounded at 20% per year, tax-free. This internal compounding is the most powerful engine of wealth creation on the planet. The speculator who jumps in and out of a stock never benefits from this long-term process. They are only betting on a change in the market's sentiment. The business owner, by staying put, is allowing their share of the company's retained earnings to grow exponentially year after year, decade after decade. Their net worth isn't just growing because the stock price is going up. It's growing because the underlying value of the business itself is compounding at a high rate. This direct financial advantage is the mathematical proof of the business owner philosophy. It transforms investing from a zero-sum game of outsmarting other traders into a positive-sum game of participating in the long-term value creation of great enterprises. It is the slow, boring, but ultimately unstoppable path to true financial freedom. Once you have made the crucial perspective shift from speculator to owner, the very nature of your analytical work must also transform. You stop asking the speculator's question, "Where is the stock price going?" and you start asking the owner's question, "What is this business fundamentally worth?" This is the analytical shift, a move away from the siren song of market prices and toward the bedrock of intrinsic value. And there is no greater story to illustrate this principle than Warren Buffett's masterstroke investment in American Express during the infamous salad oil scandal. The year was 1963. American Express was seen as a blue-chip, unassailable institution. Its primary businesses were its highly respected traveler's checks and its growing credit card division. But it also had a lesser-known and ultimately disastrous division involved in warehousing. One of its biggest clients in this division was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. Allied had taken out massive loans from Wall Street banks, secured by its inventory of salad oil, which was supposedly stored in giant tanks in Bayonne, New Jersey, and certified by American Express's warehousing subsidiary. The problem was, DeAngelis was a fraud. His tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top to fool the inspectors. When the fraud was uncovered, Allied crude collapsed, defaulting on loans worth what would be over $1.5 billion in today's money. Wall Street panicked. The banks who had loaned the money were on the hook, and they claimed that American Express, having certified the inventory, was liable for their losses. The narrative on the street was that Amex was finished. The scandal would bankrupt the company. Fear gripped the market, and investors dumped the stock in a frenzy. The price was cut in half, plunging from over $60 to $35. The entire investing world saw a company facing ruin. But Warren Buffett saw something different. He refused to listen to the noise. Instead of panicking with the crowd, he put on his business owner's hat and began his own scrupulous investigation, a classic exercise in fundamental analysis. He didn't look at a stock chart. He went out into the real world to assess the health of American Express's core businesses. He went to restaurants and travel agencies. He stood in line at banks. He talked to merchants, customers, and competitors. What he found was that the scandal, while a huge headline, had zero effect on the company's real economic engine. He observed that customers were still using their American Express credit cards with complete confidence. Travelers were still buying and using the traveler's checks as if nothing had happened. The brand, the trust, the powerful network effect that formed the company's deep competitive moat, it was all completely intact. The market was focused on the one diseased limb, the warehousing division, and was pricing the company as if the entire body were riddled with cancer. Buffett did the math. He realized that even under the most pessimistic worst-case scenario, where American Express was forced to cover every single dollar of the fraudulent loans, the per-share loss would be manageable. The incredible earning power of the traveler's check and credit card businesses would more than cover the damages over time. He calculated that the intrinsic value of the ongoing business was far, far higher than the $35 stock price. The market was offering him the chance to buy a dollar's worth of pristine, long-term earning power for less than 50 cents. Convinced of his analysis, he acted with incredible conviction. He invested 40% of his entire investment partnership's capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company settled the legal claims and its powerful core businesses continued to churn out profits, the market's fear subsided. The stock price recovered and then soared, eventually tripling and making a fortune for Buffett and his partners. The salad oil scandal is the ultimate parable of the analytical shift. It demonstrates that the market price is often just a reflection of collective emotion, in this case, fear, while the intrinsic value of a business is a reflection of its durable, long-term economics. A speculator sells in the panic. A business owner investigates the source of the panic and, if the business is sound, buys with both hands. The American Express story is a masterclass in contrarian investing, but what's happening on a psychological level is even more fascinating. Warren Buffett's ability to remain rational while the rest of Wall Street was losing its mind was not a superpower. It was a conscious and deliberate counterattack against two of the most powerful cognitive biases that lead investors to ruin: the herd mentality, also known as social proof, and confirmation bias. The herd mentality is our deep-seated instinct to follow the crowd. In our evolutionary past, this was a survival mechanism. If you saw everyone in your tribe suddenly run, you didn't stop to analyze the situation. You ran too, assuming there was a predator nearby. In the stock market, this instinct is catastrophic. When a stock like American Express began to plummet, the falling price itself became the social proof. Every seller confirmed to the next potential seller that something was terribly wrong. The narrative of Amex is doomed spread like a virus through the trading floors of Wall Street. The herd was stampeding for the exits, and the instinct for any normal person is to stampede with them, to sell before the price goes to zero. Buffett actively fought this instinct. He understood that in investing, the crowd is almost always wrong at major turning points. The consensus view is already baked into the price. To find extraordinary opportunities, you must be willing to stand apart from the herd, to think for yourself, and to trust your own work. His decision to go out and physically observe customers using Amex products was a direct refutation of the herd's wisdom. He was gathering his own primary data, rather than relying on the second-hand emotions of the market. The second bias, confirmation bias, is our natural tendency to seek out and favor information that confirms our existing beliefs, while ignoring or devaluing information that contradicts them. Once the narrative Amex is doomed took hold, investors began to actively look for evidence that supported this conclusion. They focused on every negative news story, every lawyer's quote predicting bankruptcy, every downward tick of the stock. This created a self-reinforcing feedback loop of pessimism. Buffett, in his approach to value investing, did the exact opposite. He practiced what Charlie Munger calls inverting the problem. Instead of asking, "Is this company going bankrupt?" he asked, "What would have to happen for this company not to go bankrupt?" He actively sought out disconfirming evidence. He was trying to kill his own investment thesis. He looked at the strength of the core business, the power of the brand, and the actual numbers behind the potential liabilities. By searching for the reasons why the crowd might be wrong, he was able to see the situation with a clarity that was unavailable to those trapped in the echo chamber of their own fear. Adopting the business owner mindset is a powerful psychological tool for neutralizing these biases. When you see yourself as the owner of the business, you are less concerned with what other stock owners, the herd, are doing, and more concerned with the long-term health of your enterprise. You anchor your belief system to the business fundamentals, not the market sentiment. This creates an intellectual firewall. The panic of the crowd becomes an opportunity to be exploited, not a signal to be followed. This is a core tenet of investor psychology. You cannot achieve superior results by doing what everyone else is doing. By understanding and actively combating the deep-seated psychological pulls of the herd and our own confirmation bias, we can begin to analyze companies with the rational, detached mindset of a true business owner, paving the way for the kind of long-term investing success that builds lasting wealth. To operationalize this analytical shift and turn it into a concrete, repeatable process, we need a mental model that consistently forces us to divorce our assessment of a business from its fluctuating stock price. This is where we introduce the private buyer test, a powerful intellectual exercise that forms the core of deep fundamental analysis. It's a method for estimating a company's intrinsic value, the very thing Buffett was calculating in his head during the salad oil scandal. The blueprint is to approach every potential investment not as a stock buyer, but as a private business buyer. Imagine you have enough money to buy the entire company outright, taking it private so it no longer trades on the stock market. You are now asking a fundamentally different question. What is the maximum price a rational, informed business person would pay for this entire enterprise, with the intention of owning it for its future cash flows? This simple reframing changes everything. It forces you to ignore the daily market chatter and focus exclusively on the economic engine of the business itself. The first step in the private buyer test is to understand and project the company's future owner earnings. Owner earnings are the true measure of a business's cash-generating power. It's the net income plus non-cash charges like depreciation, minus the average amount of capital expenditures the business needs to spend to maintain its competitive position. In simpler terms, it's the cash that the business could, in theory, hand over to you, the owner, at the end of each year. This isn't a number you'll find on the front page of a financial website. It requires digging into the company's financial statements, the income statement, balance sheet, and cash flow statement, and making a conservative, reasoned projection of how much cash this business can be expected to generate over the next 5, 10, or even 20 years. A private buyer doesn't care about next quarter's earnings per share, they care about the cumulative river of cash the business will produce over its lifetime. The second step is to value that stream of future cash flows. $1 of earnings 10 years from now is worth less than $1 today because of the time value of money and inflation. So you must discount those future owner earnings back to their present value. This process, known as a discounted cash flow or DCF analysis, is the analytical heart of value investing. You choose a reasonable discount rate, often based on the return you could get from a very safe investment, like a U.S. Treasury bond, plus a premium for the added risk of owning a business, and you use it to calculate what that entire future stream of cash is worth in today's dollars. The sum of all those discounted future cash flows is your estimate of the company's intrinsic value. This is the price a rational private buyer would be willing to pay. The final step is the most crucial one, and it connects directly to our next pillar, the margin of safety. Once you have your calculated intrinsic value, you compare it to the company's current market capitalization, the total value of all its shares. You only buy if the market price is at a significant discount to your calculated value. You want to buy $1 worth of business for 50 or 60 cents. This provides a cushion against being wrong in your projections, unforeseen business problems, or just plain bad luck. Executing the private buyer test is not easy. It requires diligence, financial literacy, and conservative judgment. But it is the only way to anchor your investment decisions in reality. It forces you to learn how to analyze companies, not just trade tickers. By consistently asking, "What would I pay for the whole thing?" you will develop a deep understanding of the businesses you own and a powerful immunity to the market's manic depressive mood swings. This is the analytical blueprint for long-term wealth creation. To fully appreciate the discipline and rationality of the private buyer test, we must examine its antithesis, the path of the narrative chaser. This is perhaps the most seductive and dangerous trap in the modern stock market. The narrative chaser doesn't buy a business. They buy a story. They are drawn to sweeping, exciting tales of disruption, innovation, and paradigm shifts. Their portfolio is a collection of promises, not a collection of profitable enterprises. The narrative chaser's downfall is that they mistake a good story about an industry for a good investment in a specific company, and they completely ignore the price they pay for that story. The quintessential example of this folly can be found in the performance of many of the so-called disruptive innovation stocks in the post-pandemic market of 2020 and 2021. The narratives were incredibly compelling. Electric vehicles are the future, and they will replace all internal combustion engines. Genomic sequencing will cure all diseases. E-commerce will destroy all brick-and-mortar retail. These stories were not wrong. In fact, many of them are directionally correct. The mistake the narrative chaser made was believing that a good narrative justified paying any price for a company associated with it. They bought shares in electric vehicle companies that had never produced a car at scale, at valuations that implied they would soon outsell the entire global auto industry combined. They bought biotech companies with promising but unproven technologies at prices that assumed every single one of their clinical trials would be a resounding success. They were not performing a private buyer test. They had no concept of intrinsic value. Their only metric was the quality of the story and the upward momentum of the stock price. They confused a company's stock price going up with the business itself being successful. The result was a catastrophic bubble. When interest rates began to rise and the market's appetite for speculative stories waned, these stocks collapsed, with many falling 70, 80, or even 90% from their highs. The investors who had chased the narrative were wiped out. Their mistake was a failure to ask the tough, boring questions of a business owner. They never asked, what are the actual cash flows of this business today? What is a realistic projection of its future profits? At this price, what assumptions about future growth are already baked in? What is my margin of safety if this exciting story doesn't play out as perfectly as I hope? The narrative chaser is the polar opposite of Warren Buffett during the salad oil scandal. Buffett saw a negative narrative. Amex is doomed. and used fundamental analysis to discover the reality of a great business underneath. The narrative chaser sees a positive narrative. This company will change the world, and fails to do the analysis to see if there's a viable, profitable business underneath, or if it's priced for a level of perfection that is impossible to achieve. This path is littered with the wreckage of companies that had great stories but terrible economics. It's a testament to the fact that in investing, you can be right about the future of an industry but still lose your entire investment by overpaying for your entry ticket. The disciplined, analytical process of calculating intrinsic value is the only reliable defense against the intoxicating allure of a good story. It ensures that your portfolio is built on a foundation of economic reality, not on the shifting sands of market narratives. The analytical shift from price to value directly manifests on your balance sheet and in your portfolio's performance through the single most important concept in value investing, the margin of safety. This principle, first articulated by Buffett's mentor Benjamin Graham, is the financial bedrock that separates disciplined investing from outright speculation. It is the tangible, quantifiable advantage gained by thinking like a private business buyer. A margin of safety is simply the difference between a company's intrinsic value, the number you calculated using the private buyer test, and the price at which you can buy it in the stock market. Buying with a large margin of safety is, as Buffett famously puts it, like building a bridge that can hold a 30,000-pound truck, but only ever driving a 10,000-pound truck across it. It provides a cushion for error, bad luck, or the inevitable uncertainties of the future. Let's quantify this. Imagine you perform a rigorous fundamental analysis of a solid, predictable company and calculate its intrinsic value to be $100 per share. The narrative chaser, caught up in a good story, might be willing to pay $120 for that stock, hoping it goes to $150. They have a negative margin of safety. They are not just unprotected from risk, they are actively courting it. Any slight disappointment in the company's performance could cause the stock to fall back toward its intrinsic value, leading to a significant loss. Now consider the patient business owner. They wait, they watch. They let the manic-depressive Mr. Market do his thing. One day, due to a general market panic or some temporary bad news specific to the company, the stock price falls to $50 per share. At this point, they have a $50 margin of safety on a $100 business. They are buying $1 of value for 50 cents. The financial implications of this are enormous. First, it dramatically reduces downside risk. If your analysis was a bit too optimistic, and the true intrinsic value is only $80, you still have a $30 margin of safety. If the company hits an unexpected rough patch and its value temporarily declines, your purchase price is so low that you are insulated from a permanent loss of capital. Preserving capital is the first rule of successful investing. The margin of safety is your primary tool for doing so. Second, it simultaneously increases your potential for upside returns. For the stock to simply return to its calculated intrinsic value of $100, you will double your money. You don't need heroic growth or a speculative frenzy to earn a fantastic return. You simply need the market to eventually recognize the reality of the business's value. This asymmetry, low downside risk, combined with high upside potential, is the holy grail of portfolio management. It is how fortunes are built, not by taking huge risks, but by waiting patiently for opportunities where the odds are overwhelmingly skewed in your favor. This principle is directly reflected in the long-term performance of a value-oriented portfolio. It will likely lag the market during speculative, frothy manias, as the disciplined investor refuses to overpay for exciting narratives. But it will dramatically outperform during market downturns and crashes, as their conservatively purchased stocks have less far to fall and recover more quickly. Over a full market cycle, this protection against large losses is mathematically more powerful than capturing every last bit of upside in a bull market. The margin of safety is the direct financial fruit of the analytical shift. It's the profit you make at the time of purchase, not at the time of sale. It transforms your portfolio from a collection of risky bets into a fortified collection of undervalued business interests, engineered for resilience and long-term wealth creation. Having shifted your perspective to that of an owner and your analysis to a focus on intrinsic value, the next logical step is an operational one. If you truly own a business, then the executives in the C-suite, the CEO, the CFO, are not distant figures on a news channel. They are your employees. They work for you. Their primary job is to manage your capital intelligently to increase the per-share value of your business over time. This operational shift, scrutinizing management as your partners and employees, is a critical and often overlooked component of the business owner mindset. And no story better illustrates Buffett's deep focus on the quality of management than his relationship with Tom Murphy, the legendary CEO of Capital Cities/ABC. For decades, Buffett watched Tom Murphy from afar, viewing him as the gold standard of a corporate manager. Murphy was the antithesis of the empire-building, media darling CEO. He was low-key, rational, and fanatically focused on operational efficiency and shareholder returns. He and his partner, Dan Burke, ran Capital Cities with an incredibly lean headquarters and a decentralized ethos, empowering the managers of their local television and radio stations. Most importantly, Murphy was a master of capital allocation. He was disciplined about acquisitions, refusing to overpay, and he was brilliant at using the cash generated by his businesses to create more value, either through shrewd buybacks or further intelligent acquisitions. In Buffett's eyes, Murphy wasn't just running a company. He was managing capital with the same owner-oriented mindset that Buffett himself employed. The ultimate test of this conviction came in 1985. Tom Murphy, running the relatively small Capital Cities, decided he wanted to buy the media giant ABC, a company more than 3 times its size. It was a whale swallowing a bigger whale. To finance this audacious takeover, he needed a partner with deep pockets and a long-term perspective. He flew to Omaha to meet with Warren Buffett. The meeting was famously short. Murphy laid out the deal. Buffett, who had admired Murphy's track record for years, barely needed to look at the numbers of the deal itself. He was not just investing in an acquisition. He was investing in Tom Murphy. He famously told Murphy, "I'll let you know tomorrow," and then immediately called his partner Charlie Munger to say they were in. Berkshire Hathaway invested over $500 million to help finance the deal, becoming a major shareholder in the new company, Capital Cities/ABC. Buffett's rationale was crystal clear. He was betting on the jockey, not just the horse. He knew that with Tom Murphy at the helm, the combined company's assets and cash flows would be managed with extraordinary skill and a relentless focus on per-share value. His faith was handsomely rewarded. Murphy and his team integrated the two companies with incredible efficiency, cutting costs, and maximizing the profitability of the powerful ABC network and its own stations, including ESPN. The value of Berkshire's investments soared. This story stands in stark contrast to Buffett's earlier experience with the management of the original Berkshire Hathaway textile mills. He described that management team as honest and hard-working, but they were ultimately running a terrible business that was destined for failure. They were good people fighting a losing battle against the powerful economic headwinds of the declining American textile industry. This taught him a crucial lesson. Management is a multiplier. Great management at the helm of a great business creates an explosion of value. Great management at the helm of a terrible business can, at best, manage a slow and graceful decline. By shifting to an operational mindset, you start to see that when you buy a stock, you are entering into a long-term partnership with the people running the company. Their intelligence, integrity, and capital allocation skill will have a more direct impact on the long-term value of your investment than almost any other factor. You are delegating the day-to-day decisions of your business to them, and you must choose your delegates with extreme care. The reason scrutinizing management is so critical is rooted in one of the fundamental challenges of modern capitalism: the principal-agent problem. This is a concept from economic theory that explains the inherent conflicts of interest that arise when one party, the agent, in this case, corporate management, is supposed to act in the best interest of another party, the principal, the shareholders or business owners. On a cerebral level, understanding this problem reveals why simply trusting management to do the right thing is a naive and often costly strategy. In a perfect world, the CEO and the shareholders would have perfectly aligned interests. The CEO would wake up every morning thinking only about how to maximize the long-term per-share intrinsic value of the business. In reality, the agent's interests can and often do diverge significantly from the principal's. For example, a CEO's compensation is often tied to the sheer size of the company, its revenues, its number of employees, its market capitalization. This creates a powerful incentive for the CEO to engage in empire building. They might pursue large, splashy acquisitions, even if those acquisitions are done at inflated prices that actually destroy shareholder value. A bigger company means more prestige, a larger salary, and a bigger corporate jet for the CEO, even if it results in lower returns on capital for the owners. This is a direct conflict. The principal wants profitable growth. The agent might just want growth at any cost. Another major area of conflict is executive compensation. Management teams, who often have significant influence over the board of directors that sets their pay, may grant themselves excessive salaries, bonuses, and, most insidiously, massive stock option packages. While options can sometimes align interests, they can also encourage reckless risk-taking. If a CEO has a huge number of options, they might be tempted to swing for the fences with a risky bet. If it pays off, they become fabulously wealthy. If it fails and bankrupts the company, the CEO still walks away with their past salary, while the owners, the shareholders, are left with nothing. The owners suffer from the downside, while the agent gets a free call option on the upside. Warren Buffett is acutely aware of the principal-agent problem. His entire approach to evaluating management is designed to find the rare executives who have fought off this psychological temptation and truly think like principals, like owners. He looks for specific traits. First, rationality. Does the CEO make decisions based on business logic and numbers, or are they driven by ego, envy, or a desire to copy what other companies are doing? Second, candor. Is management open and honest in their communications with shareholders, especially when it comes to mistakes? A CEO who never admits to an error is one you cannot trust. Third, and most importantly, an owner-like focus on capital allocation. Does the CEO treat the company's retained earnings with the same care they would their own money? Do they have a clear and rational framework for deciding when to reinvest in the business, when to buy back shares, when to pay a dividend, or when to make an acquisition? This is why Buffett so admired Tom Murphy. Murphy was the living embodiment of a manager who had solved the principal-agent problem. He lived modestly, focused relentlessly on costs, and allocated capital with a genius that directly enriched his partners, the shareholders. By adopting the business owner's mindset, you are programming yourself to be a skeptical principal. You stop blindly trusting the agents and start evaluating them based on their actions, not their words. You are searching for that rare breed of manager who views themselves not as a hired hand, but as a fellow owner sitting in the same boat with you. How can an ordinary investor, without access to private meetings in Omaha, effectively scrutinize a management team and identify those who think like owners? The answer lies in a powerful and readily available tool, what we can call the shareholder letter test. This mental model provides a direct window into the mind of a CEO and offers a blueprint for separating the brilliant owner-operators from the promotional empire builders. The process is simple, but it requires diligence. You must gather and read the last 5 to 10 years of a company's annual shareholder letters, which are typically found at the beginning of the annual report. Your goal is not to look for buzzwords or grand promises about the future. Your goal is to assess the quality of the CEO's thinking and the alignment of their interests with yours. Here's the step-by-step blueprint for what to look for. First, assess for candor and humility. Does the CEO openly and specifically discuss mistakes made during the year? Do they take personal responsibility? A manager who blames all failures on external factors like the economy or competition, while taking credit for all successes, is not a partner you want. A great CEO, like a great scientist, is honest about what went wrong and what they learned from it. This honesty builds trust and is a powerful indicator of a rational, learning organization. In contrast, a letter filled with corporate jargon, self-congratulation, and vague platitudes is a major red flag. Second, analyze the discussion of capital allocation. This is the heart of the test. A great CEO will spend significant time in their letter explaining Korchen and Bonschen termers and Bonschen. They are deploying the company's cash. If they made an acquisition, they should explain the strategic rationale and the price they paid. If they are buying back stock, they should explain why they believe the stock is undervalued. If they are reinvesting heavily in the business, they should explain the expected return on that invested capital. Look for clarity and economic logic. A CEO who cannot clearly explain their capital allocation strategy either doesn't have one or is trying to obscure poor decisions. The letters of a Tom Murphy or a Warren Buffett are masterclasses in clear, rational explanations of capital deployment. Third, pay close attention to the metrics they emphasize. Does the CEO focus on metrics that truly drive long-term business value, such as return on equity, free cash flow per share, or growth in intrinsic value? Or do they highlight vanity metrics designed to make the company look good, such as adjusted EBITDA, which often excludes real costs, revenue growth achieved through dilutive, value-destroying acquisitions, or simply a rising stock price? A management team that consistently focuses on and is compensated based on the fundamental per-share economics of the business is a team that is aligned with the owners. Finally, read for consistency over time. By reading a decade's worth of letters, you can see if the CEO's strategy is consistent and coherent, or if they are constantly chasing the latest management fad. Does their story hold together year after year? Have they delivered on the promises made in earlier letters? This long-term view separates the strategic thinkers from the short-term promoters. The shareholder letter test is a powerful form of fundamental analysis that goes beyond the numbers. It is a qualitative assessment of the people you are entrusting with your capital. It takes time, but the payoff in avoiding companies run by self-serving or incompetent managers is immeasurable. It is a core discipline of the business owner who knows that the quality of their employees is paramount to their long-term successful investing. The path of the 99% offers a starkly different and far more dangerous approach to evaluating the people in charge. This is the path of the celebrity CEO follower. This investor doesn't perform the diligent, quiet work of the shareholder letter test. Instead, they outsource their judgment to the media and fall prey to the powerful psychological bias known as the halo effect. The halo effect is our tendency to let one positive trait of a person, like their charisma or public image, positively influence our evaluation of their other, unrelated traits, like their ability to allocate capital or manage a complex business. The celebrity CEO follower sees a CEO on the cover of a magazine, giving a captivating keynote speech, or amassing a huge social media following, and they automatically assume that this person must be a business genius. They buy the stock not because they've analyzed the company, but because they have a crush on the CEO. The story of Adam Neumann and WeWork is the cautionary tale of our time. Neumann was the quintessential celebrity CEO. He was charismatic, visionary, and incredibly skilled at storytelling. He sold a grand narrative about elevating the world's consciousness and building a global community, all while running what was, at its core, a simple office rental business. Investors, from small retail traders to large, sophisticated venture capital firms, were mesmerized by his personality. They fell for the halo. They ignored the glaring red flags that a disciplined business owner would have spotted immediately. The company's financial statements showed staggering losses. Its business model was incredibly capital-intensive and vulnerable to an economic downturn. Most critically, Neumann's own behavior, as detailed in the company's IPO prospectus, was a textbook case of a manager who had solved the principal-agent problem in his own favor, not the shareholders. He was leasing properties he personally owned back to the company, had taken out huge personal loans from WeWork, and had structured the company with a multi-class share system that gave him dictatorial control. A rational principal would have run screaming from this setup, but the celebrity CEO follower, blinded by the halo of Neumann's charisma and the intoxicating growth story, poured billions of dollars into the company at astronomical valuations. When the company attempted to go public, the harsh light of public market scrutiny caused the narrative to shatter. The valuation collapsed by over 90%. The IPO was pulled, and Neumann was ousted. The investors who had bet on the man, rather than the business and its governance, were decimated. This is the antithesis of the Buffett approach. Buffett invested in Tom Murphy, a man who actively shunned the spotlight and focused solely on operational excellence. The celebrity CEO follower invests in the Adam Neumanns of the world, people who are masters of public relations but often lack the discipline and shareholder-friendly ethos required to build lasting value. They are buying a personality, not a business. This path is dangerous because it feels so right. We are social creatures, wired to be drawn to and trust confident, charismatic leaders. But the stock market is a cold, calculating arena where charisma is worthless if it's not backed by rational capital allocation and a deep commitment to the owners of the business. The disciplined investor must learn to separate the storyteller from the steward, the celebrity from the CEO. The operational shift of viewing management as your employees has a direct and profound connection to the financial performance of your investment, and it can be measured by one of the most important concepts in all of finance: capital allocation. Capital allocation is, quite simply, the CEO's most important job. It is the process of deciding what to do with the profits a company generates. The decisions a management team makes in this regard have a monumental impact on the long-term compounding of your wealth. A business generates cash. After paying its expenses, it is left with earnings. The CEO then has 5 basic options for this cash. First, they can reinvest it back into the existing business, building new factories, funding research and development, or expanding marketing efforts. Second, they can acquire other businesses. Third, they can pay down debt. Fourth, they can pay the cash out to the owners as a dividend. And fifth, they can use the cash to buy back the company's own stock on the open market. The skill with which a CEO navigates these 5 options is the primary determinant of whether value is created or destroyed for shareholders. A brilliant capital allocator like Tom Murphy will only reinvest capital back into the business if they are confident that the expected return on that new investment is higher than what shareholders could earn elsewhere. If they can't find high-return projects internally, they will look to acquire other businesses, but only if they can do so at a sensible price. If no good reinvestment or acquisition opportunities exist, and if the company's stock is trading below its intrinsic value, they will use the cash to buy back shares, which is a tax-efficient way to increase each remaining shareholder's ownership stake in the business. Only if none of these value-creating options are available will they return the cash to shareholders as a dividend. This rational hierarchical process is the engine of wealth creation. Conversely, a poor capital allocator will destroy value. They might pour cash into low-return pet projects to satisfy their ego. They might overpay for a large, quote, transformational acquisition at the peak of the market. Or, worst of all, they might buy back stock at inflated prices, effectively overpaying for their own business. These actions are financially equivalent to taking shareholder cash and setting it on fire. We can see the results of capital allocation skill directly in a company's financial statements through metrics like return on equity, ROE, and return on invested capital, ROIC. A company that consistently generates a high ROE is one that is earning a high profit on the owner's capital. A great capital allocator is someone who can not only maintain a high ROE, but also find opportunities to deploy term or turbus capital at those high rates. This is the compounding machine in its purest form. When you buy a stock, You are hiring that CEO to be the chief capital allocator for your portion of the business. Their skill directly translates into the growth rate of the intrinsic value of your investment. A 10% difference in the annual rate of return achieved by a CEO's capital allocation decisions can, over a decade or two, mean the difference between a mediocre investment and one that creates life-changing wealth. This is why the operational shift is not just a soft qualitative assessment. It is a hard-nosed financial calculation about whose hands you want on the controls of your compounding machine. Having aligned our perspective, our analysis, and our operational scrutiny with that of a business owner, we must now confront the most difficult challenge of all: mastering our own emotions. The stock market is a relentless assault on our psychological stability. It bombards us with news, price swings, and the twin sirens of fear and greed. The emotional shift required is to cultivate a profound sense of patience and develop the ability to ruthlessly ignore the noise. A true business owner does not get a price quote on their enterprise every second of every day, and this detachment is a superpower. The ultimate embodiment of this emotional fortitude is Warren Buffett's investment in and long-term holding of the Coca-Cola Company. In the aftermath of the Black Monday stock market crash of 1987, fear was rampant. Investors were terrified that the good times were over and a new depression was imminent. Valuations across the board had been crushed. But where others saw terror, Buffett saw opportunity. He had been watching Coca-Cola for years. He saw a business that was almost perfect. It sold a simple, habit-forming product with a brand that was a global icon. Its business model was incredibly capital light. It primarily sold syrup concentrate to bottlers, meaning it didn't have to own the factories and trucks. It gushed cash. And it had an enormous runway for growth as it expanded into emerging markets around the world. For years, the stock had been too expensive for his taste. But the crash of '87 changed that. The market, in its panic, was suddenly offering him the chance to buy this crown jewel of American business at a reasonable price. Between 1988 and 1989, Berkshire Hathaway bought over $1 billion worth of Coca-Cola stock, amounting to about 7% of the entire company. The key to the story is not that he bought it, but what he did next: nothing. For over 3 decades he has held on. Think about the noise he has had to ignore to maintain that position. He held through the Gulf War in the early 90s. He held through the peak of the dot-com bubble in the late 90s, when Wall Street derided Coke as a relic of the old economy and fawned over profitless internet companies. He was called a dinosaur who had lost his touch. He didn't sell. He held through the dot-com crash, the 9/11 attacks, and the ensuing recession. He held through the 2008 global financial crisis, the greatest economic catastrophe since the Great Depression, when the entire financial system seemed on the verge of collapse. He held through the European debt crisis, through countless fears of inflation and deflation, through dozens of geopolitical flare-ups and market corrections. Why? Because none of that noise changed the fundamental reality of the business he owned. Throughout all that turmoil, billions of people around the world continued to wake up every day and drink a Coke. The business continued to generate enormous and growing profits. His focus was never on the stock price or the macroeconomic headlines. It was on the enduring competitive position and earning power of the business. His time horizon was not the next quarter or the next year, it was forever. This almost inhuman level of patience is the direct result of the business owner mindset. If you truly believe you own a piece of one of the greatest businesses on earth, why would you let the temporary hysterical mood of the market convince you to sell it? This emotional shift from reacting to the noise to focusing on the signal of long-term business performance is the final and most crucial step in becoming a true intelligent investor. It is the ability to simply sit and let the power of compounding do its work, uninterrupted by your own worst enemy, yourself. The ability to hold a great company like Coca-Cola for decades, in the face of relentless market volatility and terrifying headlines, seems almost superhuman. It is not. It is the result of a deliberate psychological strategy to counteract the powerful cognitive biases that push us toward short-term thinking and emotional reactions. The two primary culprits here are the availability heuristic and recency bias. By understanding how they work, we can begin to build the same mental filters that Buffett uses to achieve his extraordinary patience. The availability heuristic is a mental shortcut our brains use to judge the likelihood of an event based on how easily examples of that event come to mind. Events that are recent, dramatic, or emotionally charged are far more available to our memory, and thus we overestimate their probability and importance. A plane crash, for example, is a dramatic and terrifying event that receives extensive media coverage. As a result, many people have a fear of flying, even though, statistically, driving a car is vastly more dangerous. The stock market is a perfect environment for the availability heuristic to run wild. A market crash is a dramatic, emotionally scarring event. The headlines are huge. The pundits are screaming. The memory of that event becomes incredibly available, causing investors to become excessively fearful and risk-averse, often for years afterward. Similarly, a speculative bubble, with stories of neighbors getting rich overnight, becomes highly available, leading to greed and a fear of missing out. Recency bias is a close cousin to the availability heuristic. It's our tendency to give greater importance to recent events than to historical ones. If the market has been going up for the last 3 years, we tend to extrapolate that trend and assume it will continue to go up. If the market just crashed, we assume it will keep crashing. We overweight the immediate past when trying to predict the future. Buffett's genius is his ability to consciously override these biases. He inverts them. He understands that the most dramatic, recent, and available information, the daily news, the market's latest gyration, is almost always noise, not signal. It is the least important information for a long-term business owner. The real signal is the quiet, boring, long-term data. A company's consistent growth and earning power over decades, its durable brand, its stable market share. This information is less available because it's not dramatic or new, but it is infinitely more important. He achieves this emotional detachment by creating what his partner Charlie Munger calls a latticework of mental models. He doesn't just see the market through the lens of a financial analyst. He sees it through the lens of a historian, a psychologist, and a business person. He knows from history that markets have always recovered from crashes. He knows from psychology that the crowd will always be prone to fear and greed. And he knows from his business acumen that the value of a great enterprise is not determined by the headlines of the day. This multidisciplinary approach allows him to put the immediate, emotionally charged noise into its proper, long-term context. Adopting the business owner mindset is the most effective way for an ordinary investor to replicate this. By anchoring your identity to that of an owner, you automatically lengthen your time horizon. You start paying more attention to the company's annual report, a signal of business performance, and less attention to the daily financial news, a source of emotional noise. You are consciously training your brain to focus on the information that is truly important for long-term wealth creation, while systematically filtering out the seductive but ultimately destructive distractions that derail the vast majority of investors. To translate this emotional discipline into a practical, actionable behavior, we can adopt one of Buffett's most famous and powerful mental models, the punch card approach. This is not a financial calculation, but a behavioral and psychological constraint designed to force patience, discipline, and an incredibly high bar for making an investment decision. The blueprint is a thought experiment. Imagine that at the beginning of your investing life, you are given a punch card with only 20 holes in it. Each time you make an investment, buying a new stock, you have to punch one of those holes. Once you have used all 20 punches, you can't make any more investments for the rest of your life. This simple constraint immediately and radically changes your entire approach to portfolio management. The action junkie, who trades in and out of stocks daily, would burn through their 20 punches in a matter of weeks. But for someone forced to operate under this rule, every single decision becomes immensely important. It completely short-circuits the desire for constant action and replaces it with a mandate for extreme selectivity. First, the punch card model forces you to do an extraordinary amount of due diligence. If you can only make 20 investments in your entire life, you are not going to make one based on a hot tip or a 5-minute glance at a stock chart. You are going to research that business inside and out. You will read a decade of its annual reports. You will study its competitors. You will analyze its balance sheet until you know it backward and forward. You will only swing at the absolute fattest, most obvious pitches. You are forced to wait for the truly exceptional, no-brainer opportunities, the kind of investments where the odds are overwhelmingly in your favor. This instantly raises the quality of the businesses that will make it into your portfolio. Second, it forces an authentically long-term time horizon. Since each decision is so precious, you would be incredibly reluctant to waste a punch on a short-term trade. You would only invest in a business that you believe you could comfortably and happily own for a decade or more. The question is no longer, can I make a quick profit on this, but rather, is this one of the 20 best businesses I will encounter in my entire life, available at a price that makes sense? This mindset automatically aligns you with the principles of the 10-year test and the business owner philosophy. Third, and perhaps most importantly, the punch card model instills a powerful resistance to selling. If you sell a business, you don't get your punch back. That decision is final. This creates a healthy inertia. It makes you far less likely to be shaken out of a great business by a market panic or a temporary setback. You would only consider selling if the fundamental long-term prospects of the business had permanently deteriorated, or if you found a new opportunity that was so spectacularly better than one of your existing holdings that it warranted using one of your precious remaining punches. Implementing the punch card approach doesn't mean you literally have to limit yourself to 20 stocks. It is a psychological tool. By keeping this image in your mind every time you feel the urge to trade, you can impose a powerful sense of discipline on yourself. It transforms investing from a hyperactive game into a slow, deliberate, and thoughtful process of acquiring and holding a collection of truly outstanding businesses. It is the ultimate cure for the emotional volatility that plagues the 99%. The antithesis to the patient, disciplined holder of the 20-punch card is the action junkie. This individual represents the vast majority of market participants who are driven by a deep-seated and destructive emotional need to always be doing something. They confuse activity with progress, and this confusion is the primary source of their own financial demise. The action junkie's world is a constant stream of inputs. They wake up and immediately check the pre-market futures. They have financial news channels running in the background all day. They have multiple screens on their desk, displaying flashing charts, news feeds, and their own portfolio's value, updated in real time. This constant immersion in the market's noise creates a powerful illusion of being informed and in control. In reality, it is a recipe for emotional hijacking. Every piece of news, every rumor, every analyst upgrade or downgrade feels like something that demands an immediate reaction. They are not investing, they are reacting. Their decisions are not driven by a sober assessment of a business's long-term value, but by the adrenaline rush of the moment. They suffer from a profound case of what the French philosopher Blaise Pascal observed nearly 400 years ago. All of humanity's problems stem from man's inability to sit quietly in a room alone. The action junkie cannot sit quietly with their investments. They believe that their intelligence or effort can somehow influence the random short-term wiggles of the market. They are the prey upon which the patient predators, the Warren Buffetts of the world, feed. When the market panics and crashes, the action junkie, overwhelmed by the flood of negative inputs and the pain of seeing their portfolio value plummet, feels an overwhelming compulsion to do something to stop the pain. that something is almost always selling at the absolute point of maximum pessimism, crystallizing a temporary paper loss into a permanent one. Conversely, when the market is in a state of euphoric mania, the action junkie, driven by greed and the fear of missing out, feels compelled to chase the hottest stocks, buying them at the peak of the bubble, just as the patient business owner is quietly selling or sitting on their hands. Their emotional cycle is perfectly misaligned with the cycle of value. They are programmed to buy high and sell low. The financial consequences are devastating. Beyond the disastrous market timing, their constant activity racks up enormous frictional costs. Every trade generates commissions and, more significantly, taxes. They are constantly resetting the compounding clock, never allowing any single investment to grow long enough to generate the exponential returns that create true wealth. They are like a gardener who pulls up his carrots every week to see how they're growing, and in doing so guarantees he will never have a harvest. The action junkie is a tragic figure because they often expend a huge amount of time and energy on their investing, far more than the patient buy-and-hold investor. But their effort is not just wasted, it is counterproductive. It is the very source of their underperformance. The emotional shift to the business owner mindset is the only known cure for this addiction to action. It is the realization that in investing, your greatest asset is not your ability to act, but your ability to sit. The emotional shift toward patience and long-term thinking is not just a feel-good philosophy. It is the master key that unlocks the most powerful force in the financial universe, the magic of compounding. The direct financial connection between patience and wealth is mathematically irrefutable. It is the difference between a linear progression and an exponential explosion of your capital. Albert Einstein is often quoted as having called compound interest the eighth wonder of the world. The reason is that its effects are deeply counterintuitive to the human brain, which is wired to think in linear terms. If I offer you a choice between $1 million today or a penny that doubles every day for 31 days, most people's initial intuition is to take the million. But the doubling penny, through the power of compounding, would grow to over $10 million. The action junkie, the speculator who is constantly trading, lives in a world of linear returns. They hope to make 10% on a trade, take their profit, and then try to find another 10% trade. They are constantly looking for the next single step. The patient business owner, by contrast, harnesses the power of exponential growth. When they buy a piece of a great business and hold it, two forms of compounding are working for them. First, there is the internal compounding within the business itself, which we've discussed. The company retains a portion of its earnings and reinvests them at a high rate of return, causing the intrinsic value of the business to grow exponentially over time. By simply holding the stock, you are a passive beneficiary of this powerful internal engine. Second, there is the compounding of the stock's returns themselves. As the business value grows, so too does the stock price over time, along with any dividends you receive. By reinvesting those dividends and allowing the capital gains to grow untouched, your investment base gets larger each year, meaning the same percentage return generates a much larger absolute dollar gain. Let's quantify this. If you invest $10,000 and earn a 10% annual return, after 1 year you have $11,000. The action junkie might sell, pay taxes on their $1,000 gain, and start over. The patient owner holds. In the second year, their 10% return is calculated on the new larger base of $11,000, earning them $1,100. In the third year, it's calculated on $12,100, and so on. In the beginning, the differences are small, but over decades, the curve sweeps upward dramatically. That initial $10,000, left untouched to compound at 10% for 40 years, would grow to over $450,000. The vast majority of that gain comes in the later years. This is the crucial point. The real magic of compounding only manifests over long, uninterrupted periods. Every time the action junkie sells a position, they are voluntarily chopping down their growing money tree and starting over with a smaller seed, having given a chunk of the wood to the government in taxes. They never allow their capital to reach the steep, explosive part of the compounding curve. Warren Buffett's personal fortune is the ultimate testament to this principle. The vast majority of his wealth was accumulated after his 60th birthday. His early years of high returns built the base, but it was the decades of uninterrupted compounding on that ever larger base that created the truly staggering numbers. The emotional discipline to ignore the noise and simply let your businesses work for you is therefore not a passive act. It is the active ingredient that allows the mathematical law of compounding to create financial gravity, pulling wealth toward you at an ever-accelerating rate. We have now journeyed through 4 fundamental shifts of perspective, analysis, operations, and emotion. The final piece of the puzzle is a strategic one. It involves zooming out from the individual stock and learning to think about your entire portfolio as a single, cohesive entity, your own personal holding company, your mini Berkshire Hathaway. This strategic shift requires you to see yourself as the CEO of You Incorporated, whose primary job is to allocate your company's capital to the best and most understandable businesses you can find. The perfect illustration of this master-level thinking is not just Buffett's purchase of a single company, but how he used one great business to fund the purchase of others. The story begins with See's Candies. In 1972, Buffett and Munger, through their holding company Blue Chip Stamps, acquired See's Candies for $25 million. On the surface, it didn't look like a typical Buffett investment. It wasn't a statistically cheap cigar butt type of company. It was a high-quality business, but it was not a high-growth business. Its market was largely confined to California, and there was limited scope for massive national or global expansion. What Buffett and Munger saw, however, was a business with a powerful brand, incredible customer loyalty, and, most importantly, pricing power. Because people loved the brand and associated it with quality and holidays, See's could raise its prices a little bit each year without losing customers. This, combined with the fact that the business did not require large amounts of capital for new factories or research, meant that See's Candies was a gusher of free cash flow. It produced far more cash each year than it needed to maintain its operations. Now, a conventional CEO might have taken that excess cash and tried to force growth, perhaps by opening hundreds of new, lower-quality stores across the country, a move that likely would have diluted the brand and produced poor returns. But Buffett, as the CEO of his own holding company, had a different, more strategic view. He saw the cash from See's not as candy money that had to be reinvested in the candy business, but as fungible capital that could be deployed anywhere in the world where it could earn the highest return. So he took the steady, reliable profits that gushed out of See's Candies year after year, and he redeployed them. He used that cash from selling chocolates in California to help buy shares in other wonderful businesses like the Washington Post, Geico, and most famously Coca-Cola. He was using a durable, low-growth cash cow business as an engine to fund investments in other larger businesses with global growth potential. This is the strategic mindset of a holding company CEO. You are not just managing a collection of individual stocks. You are managing a system of capital flows between the businesses you own. Some of your businesses might be mature cash generators, while others might be in their growth phase, requiring more capital. Your job is to make the intelligent decisions about where to allocate the collective profits of your entire enterprise. This view of a portfolio as an interconnected system rather than a random assortment of tickers is the final and most sophisticated application of the business owner mindset. It elevates you from an investor in companies to a manager of a consolidated business enterprise, with you sitting at the top, making the crucial capital allocation decisions. The strategic brilliance of Buffett's use of the See's Candies cash flow is, on a psychological level, a powerful victory over a common cognitive bias called mental accounting. Coined by behavioral economist Richard Thaler, mental accounting is our tendency to treat money differently depending on where it came from or what we intend to use it for. We create separate non-fungible buckets for our money in our minds, which often leads to irrational financial decisions. For example, a person might have $10,000 in a savings account earning 1% interest, while simultaneously carrying $5,000 in credit card debt at 20% interest. A purely rational actor would immediately use the savings to pay off the high-interest debt, as it's a guaranteed 19% return. But because of mental accounting, they see the savings as safe money or emergency money, and the credit card debt as a separate spending issue. They fail to see that a dollar is a dollar, regardless of which mental bucket it's in. The same thing happens with investing. An investor might have a safe portion of their portfolio in bonds and a speculative portion in tech stocks, and they apply different rules and risk tolerances to each bucket. They might take a small dividend check from a blue-chip stock and treat it as house money, using it to make a speculative bet they would never make with their principal capital. This is completely irrational. All capital is capital. Its sole purpose is to be deployed in a way that generates the best possible risk-adjusted return over the long term. Buffett's genius is his complete and utter rejection of mental accounting. When the cash from See's Candies flowed into Berkshire's corporate headquarters, it was not labeled candy money. It did not have to be reinvested in other food businesses. It was simply stripped of its origin and became, quote, capital. It was put into a single massive pot, with all the other cash flowing in from Berkshire's other businesses, insurance premiums from Geico, profits from the Buffalo News, and so on. Buffett's job as chief capital allocator was to take money from that single pot and direct it to wherever, in the entire universe of investment opportunities available to him, it could be used most effectively. Sometimes that meant buying more of a company he already owned. Sometimes it meant buying a new business in a completely different industry. The origin of the funds was irrelevant, only the destination mattered. Adopting this strategic mindset and overcoming mental accounting is crucial for the individual investor. You must learn to view your entire portfolio as a single pot of capital. A dividend received from your utility stock is not income to be spent. It is new capital that must be intelligently reinvested. The proceeds from selling a stock that has reached its intrinsic value are not winnings to be gambled. They are capital to be redeployed into your next best undervalued idea. By breaking down these artificial mental barriers, you begin to think like a true holding company CEO. Every dollar you have is a soldier in your army, and your job is to be a disciplined general, ensuring that every single soldier is fighting on the most productive front possible, regardless of which battle it came from. This is the path to maximizing the efficiency and compounding power of your entire financial enterprise. To effectively operate as the CEO of your own personal holding company, you need a guiding strategic principle, a mental model that governs your capital allocation decisions and keeps you out of trouble. That principle is the famous Buffett and Munger concept of the circle of competence. This is one of the most intellectually honest and powerful ideas in all of investing, and it is the blueprint for building a portfolio that you can truly understand and manage for the long term. The idea is simple. Each of us, through our experiences, our studies, and our careers, has built up a body of specialized knowledge in certain areas. Inside this circle are the businesses and industries that we can understand with a high degree of confidence. We can realistically assess their competitive dynamics, their long-term prospects, and what their key value drivers are. Outside of this circle are the vast majority of businesses about which we know very little. The blueprint of the circle of competence model is not to expand your circle as wide as possible. The blueprint is, first, to honestly and accurately define the perimeter of your circle, and second, to stay strictly within it when making investment decisions. A former software engineer might have a circle of competence that includes enterprise software companies. They understand the products, the sales cycles, and the competitive moats like recurring revenue and high switching costs. A doctor might understand pharmaceutical companies or medical device manufacturers. A banker might understand the economics of lending and credit. The key is that it doesn't matter how big your circle is. What matters is that you know where the boundary lies. As Buffett himself has said, you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. This model is a powerful defense against the deadliest sin in investing, making a mistake you didn't have to make by venturing into territory you don't understand. The most famous example of this discipline in action was Buffett's steadfast refusal to invest in technology stocks during the dot-com bubble of the late 1990s. He was openly mocked for being a relic, an old man who didn't get the new economy. His response was simple and consistent. These businesses were outside of his circle of competence. He didn't know how to predict which of the hundreds of competing tech companies would be the long-term winners. He couldn't confidently project their cash flows a decade into the future, so he simply did nothing. He stayed within his circle, buying things he understood, like insurance and consumer goods. His patience was vindicated when the bubble burst, and the vast majority of those tech companies went to zero, while his boring businesses continued to churn out profits. To apply this blueprint, you must sit down and perform a ruthless self-assessment. What industries do you truly understand at a deep, granular level? What business models can you explain to a 10-year-old? Be honest with yourself. It is far better to have a small, well-defined circle and to wait for opportunities to appear within it, than to have a fuzzy, ill-defined circle that allows you to chase whatever story is hot at the moment. By staying within your circle, you are stacking the odds in your favor. You are playing a game where you have a genuine edge, based on superior knowledge. This is the strategic foundation of building a portfolio of businesses that you can own with the confidence and conviction required for long-term success. The antithesis of the focused, disciplined investor operating within a well-defined circle of competence is a character we can call the diversifier. This term, coined by the legendary fund manager Peter Lynch, describes the investor who, in a misguided attempt to be safe, diversifies their portfolio so broadly and thoughtlessly that they essentially guarantee mediocrity, or worse. The diversifier's path is paved with good intentions, but leads to a destination of poor returns and profound ignorance about what they actually own. The core mistake of the diversifier stems from a misunderstanding of the concept of diversification. They believe that diversification simply means owning a lot of different things. So they buy dozens or even hundreds of different stocks, often in industries they know nothing about. They might buy one biotech stock, one Chinese e-commerce stock, one gold mining stock, and one software stock, not because they have deeply researched any of them, but because they feel this spreads the risk. In reality, this is not diversification. It is collection. They have assembled a financial zoo of random assets. The problem with this approach is twofold. First, it becomes impossible to follow and truly understand any single business you own. No individual investor has the time or ability to be an expert on 50 different companies in 50 different industries. The diversifier's knowledge of their holdings is, by necessity, a mile wide and an inch deep. They are an owner in name only. They have no real conviction in any of their positions, which makes them highly susceptible to panic selling during a downturn. Second, and more damaging financially, is the effect on returns. Your best investment ideas, the companies you understand most deeply and have the highest conviction in, are inevitably diluted by your worst ideas. Even if you stumble upon a huge winner, its impact on your overall portfolio will be muted because it's just one of 100 different positions. As Warren Buffett has famously said, wide diversification is only required when investors do not understand what they are doing. It is a protection against ignorance. The superior approach, he argues, is concentration, which is to put a significant portion of your capital into a small number of truly outstanding businesses that you understand deeply. The diversifier also often falls into the trap of buying complex financial products like dozens of different niche ETFs, exchange-traded funds, believing they are achieving sophisticated portfolio construction. They end up with a portfolio that is a tangled, overlapping mess of assets, with high hidden fees and no coherent strategy. They are diversifying because their frantic efforts to diversify are actually making their financial situation worse by adding complexity, cost, and a false sense of security. The strategic shift to the CEO mindset requires the opposite approach. It demands a ruthless focus. You are building a portfolio, not collecting stamps. Each business that earns a spot in your personal holding company must be of exceptional quality and must be understood at a profound level. It is far better to own 3 wonderful businesses that you know inside and out than to own 50 mediocre ones that are just names on a screen. This is the path to building a portfolio that is not just a random collection of assets, but a powerful, concentrated engine of wealth creation. The final, tangible connection between this strategic, holding company mindset and your financial results lies in the sophisticated understanding of return on equity (ROE) and the critical role of reinvestment. This is where all the pieces come together. It's the master-level game of not just picking good businesses, but of managing a portfolio of them to maximize long-term compounding. Return on equity is a simple but powerful ratio that measures a company's profitability. It is calculated by taking a company's net income and dividing it by its shareholders' equity. In essence, it tells you what percentage return the management is generating on the owner's capital. An average business might earn an ROE of 10 to 12%. A truly great business, one with a powerful competitive moat, can consistently generate an ROE of 20%, 30%, or even higher. As the CEO of You Inc., your first job is to populate your portfolio with businesses that have a history of high and stable return on equity. This ensures that the capital already invested in your businesses is working very hard for you. But the truly explosive combination, the holy grail of investing, is finding a business that not only has a high ROE, but also has the opportunity to reinvest a large portion of its earnings back into the business at a similarly high rate of return. This is the reinvestment engine of compounding. Let's quantify this. Imagine you own 2 businesses, Business A and Business B. Both earn a fantastic 20% ROE. But Business A is a mature, slow-growth company, like See's Candies in its later years, and it can only find opportunities to reinvest 10% of its annual earnings back into the business. It has to pay out the other 90% as a dividend. Business B, however, is in a high-growth industry and has a long runway of opportunities. It can productively reinvest 100% of its earnings back into the business at its 20% ROE. The growth and intrinsic value of Business B will be dramatically higher than that of Business A. Business B is a true compounding machine. Now here is where the strategic CEO mindset comes in. You own both businesses. You receive the large dividend from Business A. You now have a capital allocation decision to make. Thanks to your victory over mental accounting, you know this is not dividend income to be spent. It is new capital for your holding company. You look at your options. You could reinvest it back into Business A, but it has limited growth prospects. Or you could take that cash from Business A and use it to buy more shares of Business B, which you know can reinvest that capital at a much higher rate. The rational strategic move is clear. You systematically reallocate the cash generated by your slow-growth, high-return businesses into your high-growth, high-return businesses. This is precisely what Buffett did with the cash from See's Candies. He was performing corporate-level capital allocation on his own portfolio. This strategic view transforms portfolio management from a static exercise of buying and holding into a dynamic process of optimizing capital flows. You are constantly assessing which of your businesses has the best opportunities to reinvest capital, and you are directing your holding company's uninvested cash toward those best opportunities. This is the ultimate financial manifestation of the business owner mindset. It is the pinnacle of the value investing philosophy, where you are not just a passive owner of businesses, but the active, strategic architect of your own compounding machine. You have just completed an immense journey. You have fundamentally rewired your financial brain. The flashing green and red lights that once held so much power over your emotions should now seem like the meaningless distractions they truly are. You have acquired a new lens through which to see the world of investing, the lens of a business owner. You've learned to shift your perspective from short-term speculation to long-term ownership. You've learned to replace the question, "What is the price?" with the far more powerful question, what is the value? You've learned to scrutinize the managers of your companies as your own employees, to cultivate a profound emotional patience, and to see your entire portfolio as your own personal enterprise. This is not just a collection of interesting ideas. It is a powerful mental toolkit, a complete system of thought that, when applied with discipline, can serve as the foundation for a lifetime of wealth creation and financial security. You have invested your most valuable asset, your time, to acquire this knowledge, and that investment has armed you for success. But it is crucial to understand that this is only one part of a larger, interconnected system. The business owner mindset is the foundation, the concrete slab upon which the entire skyscraper of wealth is built. But a foundation alone is not a skyscraper. Warren Buffett's system is a latticework of interlocking mental models. Today you have mastered the single most important one. But how does this connect to the idea of a margin of safety? How does the concept of a circle of competence dictate which businesses you can even begin to analyze? What about the specific financial metrics that reveal a company's competitive moat? Each principle is a single, powerful node in a network of wisdom. Mastering one gives you strength, but mastering the network gives you invincibility. You have just been given a detailed map of a single, crucial country, but the entire world, the complete mental arsenal of the world's greatest investor, remains to be explored. The video that is now appearing on your screen is not a random suggestion. It is the next piece of that map. It is the link that connects the foundational philosophy you've just learned to the next layer of practical application. Think of what you've learned today as the why. That video is the how. It is the next step in assembling the complete intellectual toolkit you need to navigate the complexities of the market with confidence and clarity. The journey to becoming a truly intelligent investor is a process of layering these models, one on top of the other, until they form an unbreakable framework for rational decision-making. You have already taken the most difficult and important step. You have chosen to leave the path of the 99% and embark on a more disciplined journey. The question now is whether you will continue that ascent. The choice is not about watching another video. It is a choice about your identity. Are you a person who starts a journey and stops at the first waypost, or are you a person who sees it through to the end? Are you content with a single tool, or do you want the entire workshop? If you are committed to completing your financial education and mastering the art of long-term successful investing, the next step is right there, waiting for you. Click and continue your ascent.